what are the its types and some of its feature. Now, in today's lecture, we will solve few of the questions just to get better understanding that what is how to evaluate the stock or the shares. We already have an idea that there are two types of the stocks, and number one is preferred stock and the other one is a common stock. Preferred stock and common stock. Preferred stock, as name suggests, that where you would give priority to the stockholders. Okay, so we already have a discussion in the previous lecture, but in that lecture we will see that how we can evaluate them and how can we find the value in the preferred stockholders. So the idea remains same as we have a theoretical idea. Formula would be for the preferred stock, V is equal to, like the valuations is D divided by K. This is a dividend, and this is required rate of return. Okay, let's take an example to solve these questions, because in paper point of view normally you will get questions in the common stock holders or the common stock models. Okay, but because we have that, so we will get just to an understanding that what is a preferred stock and how we can find that. For example, let's take an example. Company is offering a dividend of let's say 6% or 6.40, where they are offering required rate of return K, which is 9.3%. Okay, and they have a condition that in next year, if required rate of return changed from 9.3 to 10.5%, then what will be the valuation of the preferred stock? Okay, first find part A, and we have 6.40 and 9.3%. Then we will get for a year 1, V1 is 68.81, and for a year 2 that they are saying that if our required rate of return changed from 9.3% to 10.5%, then what would be the scenario? We just have to change the value 6.40. Now it's changing to 0.105, so the value is 60.95. so 68.81 minus 60.95, so that is 7.87. So what is the indication? Due to the risk, the price of the stock. Now how you will explain? Due to the risk, price of stock would be reduced 7.87% in every year. So this is the indications of that 7.87% the values in the preferred stockholders. Now we have to put more attentions on the common stock. Common stock model number 1, which is constant growth. What constant growth means? An approach to dividend valuations, or to find a dividend valuation that assume as a constant. Like for example 5%, 6%, it would remain forever. Keep in mind you would get the word always or forever or infinite. Okay, that's mean anything you would receive, like 5% you would receive for a finite period of time. Okay, you would receive for an infinite period of time, you would receive forever, or you would receive always. So that means that is this is the case of constant growth. So constant growth, we have a formula for that. Constant growth is V is equal to D1 KE minus G. Keep that in mind. D1 is current year dividend, current year dividend while K is required rate of return and G is growth. Let's take an example to solve the questions. For example, a company announced dividend per share 3 rupees. How much dividend we have? 3. Company is expected to grow at 9% forever. How much growth we have? 9%. It may require rate of return 13%. May require rate of return is 13%. Then calculate the intrinsic value of the stock. We have to calculate V. Just put the value 3 KE, which is 13%, minus G, which is 9%, and ultimately 3 divided by 4%, and we will get 75. Intrinsic value is 75. Now move on to model number 2, which is no growth model or zero growth model. No growth model. Take a same example, that means G would remain 0. Let's take a same example as we have mentioned above. So what would be the scenario? The scenario would be V is equal to 3 and 13% minus G would be 0. And how much we will get is 3 divided by 13%, and V would be equal to 23. Okay, that is the scenario for zero growth model. Okay, let's make it complicated. For constant growth, let's say, as I said, it's a current year. For example, company is announcing a dividend. Company has announced dividend in 2022. Let's go back to 1 year back. For example, if company is offering dividend in 2023, then that would be D1. And if company is offering dividend in year back, like 2022, then that dividend would be denoted as D0. Okay, that means this is the previous year dividend. Okay, previous year dividend. Then if we have that kind of a scenario, then how we would solve? For example, in 2022, company declared a dividend of rupees 2.75 per share. Company is offering how much? D0. It's 2.75 per share, rupees per share. Company is expected to grow at 11%. Company is expected to grow at 11%, which may require rate of return 14%. Okay, calculate V. Now, the scenario is over here, D0. If we have a D1, then we can solve it like that. But if we have a D0, first you would need to calculate D1. And how would you calculate? D1 is equal to D0 1 plus G power N. 1 plus G power N. D0 we have 2.75 and 1.11. So is because of 1 year gap, so power will be 1. For instance, if company is offering dividend in 2021, then formula would remain same, however the power would be 2. If the company is offering dividend in 2020, then whatever the dividend they gave us in the question, that would be D0, and the power would be, like, you have to make it 2023, so you would take the power of 3. So when you will solve it, you will get D1, which is equal to 3.05. Just put it into the formula. V is equal to D1 we have 3.05, and we have a required rate of return that is equal to 14%, and minus growth, which is 11%, and when you will solve, you will get 101.66. Now, come on to the third model, that is variable growth model. Variable growth model. Till now, we have understand that if there is no growth and if there is a constant growth, but in any case, the growth is changing with the passage of time. For example, 1 year it would be 2%, and in next year it could be 3%, and next year it could be 4%. Then what would be the scenario? Then how we can solve these questions? For example, let's take an example. A company is offering a dividend. Let's say we have dividend that is equal to 2.55%, and the growth rate for first 3 year, like G1 to 3, is 25% for a 3 years, and 10% for a year 4, 10% for year 4, and that 10% is infinite. For example, if they are saying that it would be 10% for a year 4, that means after 4 years that 10% would remain same. So what would be the required rate of return? That they are offering required rate of return 15%. Then how we can solve these model? Okay, now because they are offering D naught, in the previous year they have announced the dividend. So first we need to calculate D1. D1 is equal to D naught 1 plus G. D naught we have 2.55. G for the first 3 year it would be 1.25, and here we have D1 is 3.1875. Come on to D2. D1 1 plus G, and D1 we have 3.1875. Again it would remain for a 3 years, so D2 we will get 3.98. Come on to D3. D2 1 plus G. D2 is 3.98, 1.25. So D3 would be 4.980. Come on to D4. D4 is D3 1 plus G. Now D3 would be that 4.980. However, here the growth has been changed to 10%. So 1.10. So D4 we have 5.478. I will let you know that why we are calculating the dividend. Now the formula is that V is equal to D1 1 plus K1, D2 1 plus K2, D3 1 plus K3. Now the scenario would be slightly changed in the last year, where you have a same or infinite or the forever amount of the growth amount. So you have to use the constant growth formula, that was D1, but here you will put D4 KE minus G. Now you just have to multiply by with 1 plus K and minus 1. Just put the values. D1 we have 3.1875. 1 plus K we have 1.15. Then plus D2 we have 3.984 divided by 1.15 power 2. D3 we have 4.90, 4.980, 1.15 power 3. D4 we have 5.47, 5.478. KE we have 15%, and for growth, how much growth we have? We have 10% because of the fourth year. So its KE we have in the question is 15%, and for a year 4 we have 10%. So when we will deduct it, so we have 0.05, and when you will multiply by with, it would be 1.15 and minus 1. So we have a number of years 4. So and when we will uh, deduct 1 from 4, that would be 3. So we have 2.771, 3.0124 plus 3.2475, and when you will calculate it, it would be 109.56 and multiply by with uh, 0.0657, and when you will calculate it, it would be become 9 9.0309 plus 72, and we will have a value that is 81.0309. So that is the valuation in the variable growth model. So that was the end of